Topic examines mortgage-backed security, MBS, instruments and their market features, focusing on the structure, cash flows, risks and valuation characteristics of mortgage-related securitized products. Mortgage-backed securities are created by pooling residential or commercial mortgage loans and issuing securities backed by the resulting cash flows. Investors receive payments derived from homeowners' principal and interest payments on underlying mortgages. MBS markets are among the largest and most important sectors of global fixed income markets because they provide financing for residential housing and commercial real estate activity. Understanding mortgage-backed securities is essential for analyzing securitized products and managing fixed income portfolio exposure to interest rate and prepayment risks. Residential mortgage loans possess several important characteristics that influence MBS cash flows and risk. Mortgages are typically amortizing loans, meaning borrowers repay both interest and principal over time through periodic payments. Common mortgage structures include fixed-rate mortgages, where the interest rate remains constant, and adjustable-rate mortgages, where rates periodically reset based on benchmark interest rates. Mortgage loans are usually secured by the underlying property, giving lenders legal claims on collateral in the event of borrower default. The timing and magnitude of mortgage payments depend on borrower behavior, prevailing interest rates, housing market conditions, and economic factors influencing homeowners' ability or willingness to repay debt obligations. The topic distinguishes between agency and non-agency mortgage-backed securities. Agency MBSs are issued or guaranteed by government-sponsored entities such as Fannie Mae, Freddie Mac, or Ginnie Mae. These securities generally carry lower credit risk because investors benefit from explicit or implicit government support. Non-agency MBSs, often called private label securities, are issued by private financial institutions without government guarantees. Consequently, investors in non-agency MBSs face greater credit risk and typically demand higher yields as compensation. Credit quality in non-agency structures depends heavily on borrower characteristics, underwriting standards, collateral quality, and credit enhancement mechanisms designed to absorb losses arising from mortgage defaults. One of the defining features of mortgage-backed securities is prepayment risk. Homeowners may repay mortgage loans earlier than expected by refinancing, selling properties, or making additional principal payments. Declining interest rates often encourage refinancing because borrowers seek lower mortgage costs. For MBS investors, early prepayments shorten the expected life of securities and force reinvestment at lower prevailing yields. Conversely, when interest rates rise, prepayments typically slow because refinancing becomes less attractive, extending the maturity of mortgage-backed securities. This uncertainty regarding cash flow timing distinguishes MBSs from traditional fixed-income securities and significantly complicates valuation and risk management within mortgage-backed markets. Pass-through securities are the simplest form of mortgage-backed security. In a pass-through structure, principal and interest payments collected from borrowers are passed directly through to investors after deducting servicing and guarantee fees. Investors therefore receive proportional shares of the cash flows generated by the underlying mortgage pool. Although pass-through securities provide relatively straightforward exposure to mortgage cash flows, they remain highly sensitive to changes in interest rates and borrower prepayment behavior. Investors in pass-through securities face both contraction risk, where declining rates accelerate prepayments, and extension risk, where rising rates slow repayments and lengthen expected security duration. Collateralized mortgage obligations, or CMOs, are more complex MBS structures designed to redistribute prepayment risk among different investor classes. CMOs divide mortgage cash flows into separate tranches with varying maturities, payment priorities, and risk characteristics. Some tranches provide more stable cash flows by absorbing less prepayment variability, while others assume greater exposure to contraction or extension risk in exchange for potentially higher yields. Sequential pay structures allocate principal payments according to predetermined priorities, while planned amortization class tranches attempt to provide more predictable repayment schedules. These structures allow investors to select mortgage-related securities aligned with specific investment objectives and risk tolerances. The valuation and risk analysis of mortgage-backed securities differ from those of traditional bonds because cash flows are uncertain and depend heavily on interest rate movements and borrower behavior. Analysts use measures such as effective duration and option-adjusted spread to evaluate MBS sensitivity to changing rates and prepayment assumptions. Mortgage-backed securities often exhibit negative convexity because declining interest rates accelerate prepayments and limit price appreciation. Conversely, rising rates extend security duration and increase price sensitivity. These characteristics make MBS valuation more complex than valuation of standard fixed-rate bonds and require sophisticated modeling techniques incorporating interest rate scenarios and prepayment forecasts. Topic ultimately demonstrates that mortgage-backed securities are essential yet complex components of global fixed-income markets. MBSs provide liquidity and financing for housing markets while offering investors access to diversified pools of mortgage loans. However, these securities involve unique risks related to borrower defaults, prepayments, contraction risk, and extension risk. Agency and non-agency structures differ significantly in credit quality and government support, while CMOs and pass-through securities provide varying exposure to mortgage cash flow uncertainty. Mastery of MBS instrument features and market dynamics is therefore critical for evaluating securitized products, managing interest rate exposure, and constructing diversified fixed-income investment portfolios.